Your credit score plays a quiet but powerful role in your financial life. It can determine whether you get approved for a loan, what interest rate you pay, and even whether you land that new apartment. The higher that score, the better your chances of getting access to more credits and lower interest rates. But for something so important, many people don't fully understand how credit scores are calculated. So let's break down the main components that make up your credit score and what you can do to maximize each. What is a credit score? Those 3-digit numbers represent your credit worthiness. They're your own personal financial fingerprint. It's used by lenders, landlords, credit card companies, and even some employers to assess your financial reliability. The most common credit scoring model is the FICO score. FICO stands for the Fair Isaac Corporation. They're the ones who basically developed the initial credit scoring system. FICO scores typically range from 300 to 850. Remember, the higher the score, the better. It usually means you'll get better loan terms, lower interest rates, and easier approvals. Payment history, 35%. This is the single most important factor in your credit score and is the largest piece of the pie. And it's the first thing lenders look at because they want to know if you've been paying your bills on time and how long you've been doing so. This helps them gauge the risk of lending you money and includes things like credit cards, retail accounts, installment loans like auto loans, mortgages, and even some utility bills if they're reported. They'll also be watching public records and noting anything you may have in collection. Your payment history basically shows how reliable you've been in repaying your debts over time. It's a big deal because research suggests that how you've handled payments in the past is a pretty good indicator of how you'll handle them in the future. This is important because lenders want to see a history of liability. A single late payment, especially one that's 30 days or more overdue, can stay on your credit report for up to 7 years. When lenders are considering payment history, they're looking at things like payment details from credit cards, loans, and mortgages, how overdue any late payments are both currently and in the past, the amount still owed on overdue accounts or collections, the number of past due items on your report, how much time has passed since any negative records popped up, the number of accounts you're keeping up with payments on. So how do we improve it? Put your bill paying on automatic payments or schedule payment reminders. This is about paying on time. Even if it's just the minimum due, pay it on time to keep a good record. Catch up on any missed payments to get current. The longer you consistently pay on time, the less those past slip-ups weigh on your score. If you accidentally miss a payment, call your lender and ask for a one-time courtesy adjustment. Even if paying on time means only paying the minimum due, the total amount of credit you owe is still very important, and it's the next section of your credit score. Credit utilization, 30%. This is just a fancy way of saying the total amount of debt you're carrying against how much total credit you have. It's calculated by dividing your total balances by your total credit limits across all revolving accounts. Things like credit cards. Having credit accounts and owing money isn't necessarily a red flag. But if you're using a big chunk of your available credit, it could signal to lenders that you're stretched thin, which might increase the risk of you missing payments. Scoring systems consider a bunch of factors to figure out what's too much debt for your specific credit profile. A high utilization ratio can indicate that you're over-reliant on credit, which may be a red flag to lenders, even if you pay it on time every month. When it comes to credit utilization, you ideally want to stay below 30% of your total credit limit. For maximum impact, keep it under 10% if possible. For example, if you have a credit card limit of $5,000 and carry a balance of $2,000, your credit utilization is 40%. That's higher than recommended and could potentially hurt your score. Now, there is some nuance to this because credit utilization doesn't necessarily only look at total debt owed compared to total credit available. It could take several other factors into consideration, like how much you owe on different types of accounts, like credit cards versus installment loans, like car loans. The number of accounts with balances. Having lots of accounts with money owed can be a sign that you're stretching yourself too thin, even if the utilization isn't above 30%. And the amount you still owe compared to the original loan amount can also be important. For example, if you borrowed $20,000 to buy a car and you've paid back $4,000, you still owe, with interest, more than 80% of the original loan. The biggest point of improvement with this section is to keep credit utilization as low as possible. Some credit isn't bad as it shows you can pay your bills on time, but try to limit how much debt you have and keep the utilization below 30%. There is the ability to ask your lender to increase your credit limit. This could help you get a lower utilization percentage. Here's a quick example. Let's say your credit limit is $3,000 and you owe $1,200. That's 40% utilization. You call your bank and ask them to increase the credit limit on your card, and they increase it to $5,000. Now your credit utilization is only 24%. Just be careful with this, because if you like to spend, you've now also added a $2,000 buffer before maxing the card out. Length of credit history, 15%. Your credit history is the seasoning that adds flavor to your financial profile. Generally speaking, the longer you've been building credit, the better it is for your scores. A longer history gives lenders a better track record of your borrowing habits. They consider three main factors: age of your oldest account, how far back your credit history goes; age of your newest account, how recently you've opened up new credit; and the average age of all of your accounts, the total age of all your credit accounts divided by how many you have. Someone who has been using credit responsibly for 10 plus years will almost always be seen as more stable than someone who just opened their first credit card 6 months ago, even if both are currently managing their credit well. Let's say you've had one credit card for 10 years and you added a second one 6 years ago. Currently, your average credit age would be 8 years. That's 10 plus 6 divided by 2. But if you now add a new car loan to your report, your average account age would drop to just over 5 years. 10 plus 6 plus 0 divided by 3. So even though you've been responsible, just opening up a new account reduces your average age and can cause a slight dip in your credit score, at least temporarily. When you're looking to improve this section, keep a few points in mind. Don't close your oldest credit accounts, even if you don't use them regularly. Many people close credit cards they no longer use, especially if they're trying to simplify their finances. But closing your oldest account can hurt your credit history, so try to keep that one open. If possible, avoid opening multiple new accounts in a short amount of time. Lastly, be patient. This is one factor you can't speed up. Over time, your credit history naturally strengthens. New credit, hard inquiries, 10%. In our current global economy, a lot of our world revolves around new credit opportunities. This shift is reflected in credit scores. However, every time you apply for a new line of credit, it creates what's called a hard inquiry on your credit report. These can slightly lower your score temporarily and can typically stay on your report for up to 2 years, but lenders will generally consider the ones done within the last year. This is important because too many inquiries in a short period might signal financial instability or desperation to borrow, which can be a red flag to lenders. These should not be confused with soft inquiries like checking your own credit or getting pre-qualified. These do not affect your score. Improvement tips here are simple. Space out applying for new credit if possible. And if you're on the hunt for a mortgage, car loan, or even student loan, you're most likely need to rate shop, which would mean multiple hard inquiries. But luckily, multiple inquiries within about a 14-day window are typically treated as a single inquiry for scoring purposes. So rate shop smartly. Credit mix, 10%. This is the variety of credit accounts you have, including revolving credit, like credit cards, installment loans, like car loans, and things like mortgages. Lenders want to see your ability to handle different types of credit responsibly. Showing a mix of different types of credit could signal that you're a well-rounded borrower. But don't take out loans just to improve your mix. At 10%, it's a small portion of your score. Always weigh expected risks and rewards. 3 ways to boost your credit. So now that we've talked about how credit scores are broken down, let's talk about how to boost your credit. If past financial missteps have left your credit score in need of a boost, there are steps you can take to get back on track. Prioritize timely payments. Your payment history is king. Make sure you pay your bills in full on time every month. Consider setting up automatic payments or reminders to stay on track. Keep credit card balances in check. Maxing out your credit card can tank your score and scare off lenders. Aim to keep your credit utilization under 30%, with 10% being even better. Review your credit report. Don't assume everything on your report is accurate. Mistakes happen more often than you think. Regularly review your report for errors and dispute any discrepancies you find. Federal law allows you to get a free copy of your credit report every 12 months from each credit reporting bureau. You can access this at annualcreditreport.com. Once your credit report is available, review it thoroughly. If you spot any errors, you can dispute them directly with the relevant credit bureau, Equifax, Experian, or TransUnion. Thanks so much for watching. Look, we hope you learned something new today, and if you did, please share this video with a friend, especially if they have questions about credit scores. Don't forget to like and subscribe, and we'll see you in the next one.